Welcome to DWS Market Update. The February inflation data for the euro area were a blow to the European Central Bank. The inflation rate had been expected to fall. Instead, however, it remained at 8.5%. But even worse was that the number for the core rate, inflation excluding food and excluding energy, which gives a better impression of the underlying price pressure, had not fallen but rather risen from 5.2% to 5.6%. And one has to take into account that rents, which also are part of the service sector, have hardly risen at all so far. The main drivers were therefore labor-intensive services. Their costs move in tandem with wages. And no easing is to be expected here for the time being. Everywhere you look, labor is scarce. Wages are rising and at a faster pace than productivity. Why is that? There are various reasons. For example, employment is rising in Germany if you look at the number of people employed. But the number of hours worked has not yet reached pre-COVID levels. So wages will have to rise further to attract more people back into the labor market. The situation is similar in the US, where the discrepancy between wage growth and productivity growth is currently very high. And this difference, roughly speaking, represents the inflation pressure stemming from wages. But central banks cannot tolerate this. Otherwise, employees, companies, consumers will permanently adjust to inflation, and it will become increasingly difficult to recapture it. We therefore expect the central banks to rise rates even further. For the ECB, we expect a deposit rate of 4% over the course of the next 12 months, and for the US Central Bank, even a key interest rate of just under 5.5%. What does that mean for investors? Well, rising interest rates have a slowing effect on the economy. That's not exactly the best environment for equities, especially since we are assuming only weak economic growth anyhow. The good news, however, is that bonds are now, after the rise in interest rates, yielding decent returns again. Unlike in the past, you don't have to rely exclusively on equities to make money. Over the next 12 months, for example, we expect European corporate bonds to show a similar performance as European equities. This is good news. If you add bonds to an equity portfolio, the volatility decreases significantly, yet the expected return is not significantly affected. With this, I say goodbye until next time.